Good morning, everyone, and welcome to this week's episode of Capital and Context. You will notice there's a slightly different layout to what's going on this week. There is no Mark. Mark is currently in the air on the way back from our Cape Town office back to the UK. So I thought I'd go over some questions that I keep on getting asked, which is an interesting way of trying to catch all bases and also hopefully answer some questions that are like in the back of your mind that you haven't asked anyone yet. Just looking at the environment that we're in right now. So obviously April's been a month full of contradictions. There's no shortage of questions. What I thought I'd do is kind of field 5 questions I've been getting asked, roughly about 3 minutes each. And so without further ado, let's get straight into it. Got my questions here. So question number 1. My client is pleased with April performance, but is worried about what is happening in the Middle East. What should I tell them? So this is a question that sums up kind of like the paradox around 2026 almost perfectly. So on the month, we got the S&P up around about 9%, NASDAQ up 14%, Russell 2000 is well ahead. This is actually the best month for both indices since April 2020. Just shows, how, when you've had decline, the bounce back can be really quite sharp. But paradoxically, we still, the Iran conflict has not gone away. And that's one thing that I think markets very much got ahead of themselves for this month, is the fact that, yes, we got less bombing going on, but economically the results are still the same. We still got the Strait of Hormuz being in effect double closed. We got Iran closing it actually within the strait, and then we've got the flotilla of US ships outside of it also stopping things going out, although a few ships are getting out suspiciously, all Chinese. So we're still going to end up with like the inflationary issues on input costs to businesses. But what's been doing well within the portfolios has actually been it's more sector orientated. So it's the AI story. You think AI largely, think services economy is untouched by what's going on to a degree. Although there was one period we're keeping an eye on helium shipment levels because that might affect chip production, but that seems okay at the moment. And what's been really, really positive is that, so for example, yesterday, 4 out of the Magnificent 7 reported their earnings. And what we were seeing is that we're now at the point where all of this capex spend is now starting to translate into real revenue streams coming in, particularly for like the infrastructure level. So that being your Microsoft Azure, Amazon, AWS. Those earnings are up an awful lot, to around about 2/3 year on year. So they're doing really, really well. So that's what's helping really push markets up this month. Obviously, there's a degree of it seems to be an element of an everything is risk on at the moment. So we're a bit aware of that, particularly in the context of, as I said, Iran conflict is not over. We've just had over the last 24 hours Brent crude go back up to $110 a barrel, which seems about right. I think we're probably looking at might be a little bit of a pullback, but we're positioned defensively and diversified off of the back of that. So the portfolios I'm happy are in a good place. So I hope that answers that one. So question number 2. Should I be moving more of my clients into cash? Rates are still reasonable and at least it feels safe. We get this after every pullback, and it's not a surprising question. Obviously, previous episodes you would have heard myself and Mark talk about this. There's 2 problems with that strategy right now. First of all is timing. The time for that was 2 months ago. Yes, we've had a recovery, but markets are far more aware of the risks. If anything, the risk at the moment over the next week or so is actually the UK local elections. So there's things that we're doing now a little bit defensively. But what can often happen within down when there's been pullback is that's actually when you tend to find the best days of market returns. The best 10 days of market returns, individual days of market returns in the last 20 years or so have all been in bear markets. So you've got to be really careful about your timing of doing that. The second one is actually the rate outlook. Now, don't get me wrong, the outlook has adjusted upwards a bit since the beginning of the year. But generally, over a multi-year basis, rates are still moving down on cash. And the important thing is that, so money markets are in the high 3s%, that is. But when you've got inflation for the year still returning for possibly services inflation, being a bit higher than that, you could still very much end up with a negative real return. So that being the return net of inflation, and that's what you actually have to account for when with what you're doing with your investments. So the other thing to bear in mind, of course, is it depends on your outlook. If you've got a client that's circa 12 months till they need the cash, then go back to the training. That's literally the core elements of what we do. In our circumstance, absolutely, cash, money markets, etc., is where you want to be popping your money. However, with those with a more medium-term outlook, we know the score. You hold through the volatility, and if anything, there's a lot of evidence that reinforces deploy through volatility can actually be very beneficial. So that's something to bear in mind, I think. The Magnificent Seven earnings were all over the news last night. Does CBAM have exposure to these companies, and should we have more? Simple answer is yes, we do have exposure. Do we want more? I'm going to say no. And let me explain why. So we have exposure to the Mag 7 through our passive US holdings. So we have roughly a market weighted exposure to that. But the thing is, the Mag 7 concentration within the S&P 500 is very, very high indeed. And that creates a bit of concentration risk, a bit of a specific risk with, you'll become a little bit more reliant on a few companies for your performance within your portfolio. So do I want more of that within the portfolio? I'm going to say no, not necessarily from an outright returns basis, but because I don't feel it would be considered good portfolio construction to have that concentration bias and that reliance on basically one set of outcomes. The key thing that we have to do is create that diversified portfolio with that diversified set of outcomes that are positive. And that's why we don't hold a standalone global tech fund, even though I attend many global tech fund meetings. But it helps me understand the market that's going on. And not just that, you hear an awful lot, not necessarily through directly what a fund manager might say, but the tone in which they say it. And there was a meeting circa 6 months ago where a tech fund manager who I spoke to, several years prior, he was incredible. You could see in his face, he was riding a wave, and from a career standpoint, he was loving life. And he was a bit more flat, and that to me was a sign of like, okay, the time to have a standalone holding has gone. So I'm happy with where we are market cap. If anything, I'm a bit wary of if there is a further pullback, as we often see, earnings go up and then people go, hang on, it's expensive pullback. So I think where we are is fine. An awful lot of people, other MPS providers, hold less of a Mag 7 than we do. And that's partly why they've underperformed versus us over the last year or so. Just on the fact that they've been, I think, reading too quickly into narratives without doing their own research. When we look at last night's earnings, as I said, so just got my notes in front of me. So referring to those Microsoft and Alphabet, not AWS, but AWS is on here as well. The Azure part, which is their cloud computing of Microsoft, that grew 40%, so that's great. Alphabet Cloud grew 63%. So, it's just showing that the money that they're spending on expanding that AI, the infrastructure behind it runs obviously on the cloud infrastructure. They're getting the client base, i.e. your ChatGPTs, etc., to run off of that really, really well. And and it's been translated to capital expenditure that everyone has been fretting about into actual revenue acceleration. So that's very positive. And Amazon had AWS grow for 28%, bearing in mind that AWS seems to run half of the internet, it seems, these days. So that's a big deal. And the consumer business held up well despite the oil shock. But I think any consumer weakness you might see might come up in Q3 of the year. I think it just takes a little bit of time. Lag says, obviously, I think crude oil is very much an input, a primary input into the system. It takes time for it to go through through one factory into another factory before it ends up at the consumer. So I think we're still a quarter or so off of that becoming a big issue for consumers. Is that one done? I have a client who read that OpenAI is in trouble. They want to know if that means the AI theme is over. So this is interesting, considering I was just saying about at the infrastructure level, everything's actually going really quite well. It's quite interesting when you look at that step under, which is the application level. So basically the products that run on the infrastructure, and the application level is basically what me and you interact with. So in this case, ChatGPT. So there was a report in the Wall Street Journal that OpenAI has fallen short of its internal revenue growth targets, and the company's chief financial officer raised concerns about whether it can meet its computing contracts if growth continues to disappoint. I would wager that in the second half of 2025, quite a lot of people moved across from ChatGPT to Claude. Anthropic seemed to hoover up an awful lot of business in that period. We've had, myself and Mark, obviously, have had podcast episodes talking about this. And so what this means is it is an important signal. But what these OpenAI, etc. companies, they need to prove now that the revenue is going to come through. I actually find that there's some really healthy signals here, in that the market is being far less over optimistic and ignorant of the risks and the need for revenue to come in off of the capex spending. An example of this is Meta, so Facebook, although it beat earnings last night, it raised up its capital expenditure on AI again last month, and the market didn't react very well off of this. And the reason for this is that the path to revenue growth off of AI, off of capital expenditure spend on AI for Meta, is a lot more hard to understand, and as a result, the market is being balanced in its views. And I think the same is happening here. Is the market is a lot more cognizant as to what it needs to achieve, and I think it's good for the consumer that AI has now realised that OpenAI has now realised that they aren't the only player in town. A lot of businesses are spreading out their applications that they're using, and it'll be good for the consumer, because then ultimately competition equals a better product. So I think that's good, and the AI theme is maturing, and obviously a mature market where revenues are coming in is more healthy than a speculative one. And the important thing is as well is to remember is that the application layer, so that being OpenAI, Claude, etc., with the exception of Microsoft Copilot, all of those businesses are private. So they're not going to have a massive direct impact onto your portfolio. So the part of the portfolios that is exposed to AI is that infrastructure layer, which has been doing really well. It should continue to as well. question number 5, which is my last one. So it's a nice short episode this week. What is the one thing that I would want every advisor listening to take away from April 2026? So April 2026 was a month that kind of stress tested a lot of assumptions altogether, and very glad that the portfolios held. So despite the fact that we very clearly had a big relief rally, and that's why last month when we did our portfolio trades, we did them as a rebalance, bring everything that's sold off back up to target weighting, which means that you get exposed more on the recovery. So that was good there. As we expected, IMF cutting growth forecasts, which isn't surprising, means that we need to be selective in which geographies we hold sovereigns. Our trades that we did last month, so moving into treasury inflation protected securities, they outperformed. A lot of what we held of our trades last month have outperformed, so that's been very beneficial. And I think our MPS finished the month positive and in many cases very strongly positive indeed. I think the need for that ability to be calm in these markets is very important. I think we're going to continue to have a choppy year, and it's the ability of us to do our scenario planning well in advance. Our scenario planning is, obviously we're including looking at next month. If Starmer is basically made to stand down, it's actually quite hard to remove a Labour leader, but if he stands down next month, what that does to markets. We're also looking at if the US foreign policy starts getting more concentrated on Greenland again, or if it goes to Cuba. But fortunately, in not such a nice way, the concentration is kept in one place at the moment, which is Iran. So there's all this scenario planning that we're doing all the time, and it's that scenario planning that means that when something starts to occur, we can react really quickly, rather than being looking quite in retrospect about what we should have done. We're ready to go straight away. I think the big one for advisors and clients is that the advantage in an NPS is not what it generates necessarily in good months. And I know we're talking about this about April. It's actually about how it protects in down months. And looking at what happened last month, it took a little while for the numbers to come through just because things were a bit choppy. But we outperformed in March quite nicely. So that helps, keep portfolios going well in upturns. And I think my thing for advisors is, is to say clearly, consistently, before volatility arrives and after it passes, is that message, is that with an NPS we can react quicker, and that it means that we're ready for recovery as and when it occurs. So I think that's my one thing I would say to take away. So that's a nice quick episode for the month. Thanks for listening to Capital and Context. Mark is back in the UK next week, which I'm quite glad for. I've missed my sparring buddy here. It feels weird to be talking about my managing director in those terms. Obviously, if you've got questions, please comment them, email them in to the team. We actually really enjoy answering questions because I've said it many times on the episodes. If we can't answer a question, it means that we need to test our own assumptions. Just lastly, the usual compliance disclaimer. Capital and Context is produced by Kate Berkshire Asset Management, which is a division of Ascot Wealth Management Limited, which is authorised and regulated by the Financial Conduct Authority. The views expressed in this podcast are those of the presenter and for informational purposes only. They do not constitute financial advice and should not be relied upon as the basis for any investment decision. Past performance is not a reliable indicator of future results. However, I haven't mentioned any past performance numbers today. Value of investments and any income with them can fall as well as rise, and you may get back less than the amounts you originally invested. If you have any questions about your own financial situation, please speak to your advisor. Thank you very much. Have a great weekend.